Hello and welcome. Today we are diving deep into a topic that is, and I mean this, absolutely essential if you're serious about building long-term wealth: investment portfolio strategies. The best way to think about this is as the master blueprint for your entire financial future. We're going to break down exactly how to build, manage, and really fine-tune your investments in a way that's clear and makes sense. So let's just jump right in with the most fundamental question of all. Think about it like this. You would never, ever dream of building a house without a detailed blue plan, right? I mean, of course not. You'd need plans for the foundation, the frame, the electrical, the plumbing, the whole shebang. It's really the only way you can be sure that the house is going to be solid and actually be the home you want. So here's the big question. Why on earth would anyone approach building their life savings, their financial house, without that exact same level of planning? An investment portfolio strategy, well, that's exactly what it is. It's your blueprint. So here's our game plan. We've laid out this journey into 5 key sections. We're going to start by laying the groundwork with the absolute unbreakable rules of building a portfolio. Then we'll get into the big philosophical choice. Are you a passive investor or an active one? From there, we'll get super practical and look at 3 popular portfolio designs you can actually use as models. After that, we'll talk about the crucial stuff: long-term maintenance. And finally, we're going to tackle what is often the biggest hurdle of all: your own mindset. I promise, by the end of this, you'll have a complete framework to start building. All right, let's get into it. Section 1, the foundational blueprint. Before you even think about picking a single stock or fund, you have to understand the core principles that every, and I mean every, successful portfolio is built on. You can think of these as the laws of physics for investing. They're non-negotiable. The first, and honestly the most critical principle, is asset allocation. Now, if you only remember one thing from our time together today, please let it be this. Asset allocation is just the decision of how you split your money up between different kinds of investments. We're mainly talking about stocks, bonds, and cash. Decades of financial research have shown time and time again that this one decision, how much you put in stocks versus bonds, is the single biggest factor that determines your long-term returns. It is more important than picking the perfect stock. It's more important than trying to time the market. It is the foundation of your entire financial house. And working right alongside asset allocation is our second unbreakable rule: diversification. You've all read the old saying, right? Don't put all your eggs in one basket. Well, this is the Wall Street version of that timeless piece of wisdom. Diversification means spreading your money out not just across different companies, but across different types of companies, different industries, like tech and healthcare, and even different parts of the world, like the US and international markets. This is what protects you. When one part of your portfolio is having a bad year, another part might be doing great, and that helps smooth out the ride and seriously reduces your overall risk.
So here you can see that first principle, asset allocation, in action. This is the classic 60-40 portfolio, and it's a super common starting point for an investor who's got a kind of moderate appetite for risk. See that? 60% is in stocks. That's your engine. That's what's going to drive long-term growth. The other 40% is in bonds, and their job is to provide stability and income. They act like a shock absorber when the stock market inevitably gets bumpy. This simple split has been the bedrock of countless investment strategies for a very long time.
And all of this, everything we're talking about, is governed by one fundamental law of investing: the risk-return trade-off. It's actually pretty simple. If you want the chance to earn higher returns, you absolutely have to be willing to accept higher risk. There's no free lunch here. Stocks, they offer the highest potential for growth, but they also come with the biggest ups and downs. Bonds are way safer, but you're going to get lower returns. Your main job as an investor is to find that sweet spot, that balance between risk and return that lets you sleep soundly at night. Okay, now that we've got the foundations poured, we can move on to section 2. And this is where you face your first major design choice. It's a big one. The question is this: are you a hands-off architect who designs the plan and lets it run, or are you a hands-on builder who's in there every day tweaking things? This really gets to the core of the whole passive versus active investing debate. This chart lays out the 2 philosophies perfectly. Over on the left, you've got passive investing. The goal here is super simple: just match the performance of the overall market. You do this by buying low-cost index funds. Think of something that tracks the S&P 500. It's a buy-and-hold strategy that takes minimal effort and has incredibly low fees. Now, over on the right, you have active investing. This is a much more ambitious goal. You're trying to beat the market. This means you're doing deep research, picking individual stocks you think are winners. It takes a ton of effort, constant watching, and it comes with much higher fees. Now, there's no right or wrong answer here. The best choice for you really depends on how much time you have, your skill level, and frankly, whether you believe you can consistently outsmart the millions of other smart people trying to do the same thing. Okay, section 3. Let's get down to brass tacks. It's time to look at some popular real-world portfolio designs. We're going to explore 3 time-tested blueprints that you can use as inspiration for building your own financial house. And first up is the one we've already touched on, the classic 60/40 portfolio. There's a good reason this has been the bedrock of investing for decades. Its beauty is really in its simplicity and its balance. That 60% in stocks is your growth engine, pushing your portfolio forward over the long run. Meanwhile, that 40% in bonds acts as a stabilizer, a cushion, protecting you during those inevitable stock market downturns. It's a design that aims for solid, long-term returns without giving you a heart attack from all the risk. Next up, we've got a really smart hybrid approach. It's called the core satellite strategy. I like this one because it kind of gives you the best of both worlds. Here's how it works. The core of your portfolio, the big chunk, like 80%, is built with those stable, super low-cost passive index funds. That's your rock-solid foundation. Then you use the smaller satellite portion to make some targeted active bets. Maybe it's a specific industry you believe in or a few individual stocks you think could be home runs. This gives you the reliability of passive investing with the added potential for a little extra juice from active management. And for our third design, we have the all-weather portfolio. Now, this one takes a completely different approach. Instead of trying to get the highest possible returns, its one and only goal is to balance economic risks. It's designed by the legendary investor Ray Dalio to do reasonably well no matter what the economy throws at us, whether we're in a boom, a recession, a period of high inflation, or low inflation. It is a strategy built for one thing: maximum resilience. And just look at the difference when you put them side by side. The 60/40 is clearly built for growth, it's heavy on stocks, but the all-weather portfolio, it's built for stability. It holds way fewer stocks, a lot more bonds, and it adds in things like gold and commodities, assets that tend to behave differently during different economic seasons. With this one, the goal isn't to hit grand slams, it's to consistently get on base no matter what the weather's like outside. All right, moving on to section 4. Look, building your portfolio is a massive first step, but it's not a set it and forget it kind of deal. Just like a house needs upkeep, your portfolio requires regular maintenance and tuning to make sure its structure stays sound over the years. This is a step so many investors skip, but it is absolutely critical to your long-term success. So let's say you've set your target. You've chosen your blueprint. Maybe it's that 60/40 split. But, over time, the market does its thing. Your stocks might have an amazing year, and suddenly they've grown to be 70% of your portfolio, and your bonds have shrunk to just 30%. All of a sudden, your portfolio is way riskier than you designed it to be. This is called portfolio drift. So the question is, how do you fix it? How do you get it back on track? Well, the answer is a simple but powerful process called rebalancing. There are 2 main ways to do it. You can rebalance on a set schedule, say once a year. That's calendar rebalancing. Or you can rebalance whenever one part of your portfolio drifts too far from its target, say by more than 5%. That's threshold rebalancing. But you know what? Either method gets you to the same place. Rebalancing creates a system for taking profits from the parts of your portfolio that have done well and reinvesting that money into the parts that are down. It's this automatic, unemotional process that forces you to do what is so incredibly hard for us humans to do on our own: sell high and buy low. And that brings us to our final and, you could argue, our most important section: mastering your investor mindset. Because look, we can have the perfect blueprint, the most brilliant strategy on paper, but if our own psychology gets in the way, none of it matters. The single biggest obstacle to long-term investment success is often the person we see staring back at us in the mirror. I absolutely love this quote because it just nails it. Market crashes, corrections, downturns, they are a normal, inevitable part of investing. They're going to happen. They aren't the real risk. The real risk is how we react to them. There's a whole field of study called behavioral finance that has proven our brains are hardwired with these psychological biases that cause us to make predictable, irrational, and very, very expensive financial mistakes, especially when we're feeling scared or greedy. And here are 4 of the biggest mental traps that trip investors up. First, loss aversion. It's that feeling that losing $1,000 hurts way, way more than gaining $1,000 feels good. It's what makes us panic and sell at the absolute bottom. Then there's overconfidence, that dangerous little voice in your head that says, I can outsmart the market, which almost always leads to trading way too much. Then you've got herd behavior, that deep, primal instinct to follow the crowd. It's buying a hot stock at its peak because of FOMO, fear of missing out, or selling everything when everyone else is panicking. And finally, recency bias, that flawed assumption that whatever just happened is going to keep happening forever. Just knowing that these biases exist is the first huge step to conquering them. So, what's the big takeaway from all this? It's that there is no magic formula.
There's no secret to investing. A truly successful strategy isn't about finding some hidden stock tip or a complex algorithm. It is about creating a personalized blueprint, one that's built on these timeless, proven principles, and one that's tailored specifically to your own goals. And maybe most importantly, it's about having a plan that you have the emotional discipline to stick with, especially when the markets get stormy. So I'll leave you with this one question to think about. Now that you understand the different blueprints you can use, and you know about the mental biases that can trip you up, which one of those is your biggest blind spot? Being honest with yourself and knowing the answer to that question, well, that's the first and maybe the most important step in truly mastering your own financial future. Thanks for tuning in.